Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
We have 3 power-packed webinars for you this Saturday on April 5th. Do check out the one that interests you. The first one is a finesse webinar on fixed income investing in a falling interest rate environment. That's happening at 10 a.m. At 10 a.m. IST as well as 12:30 p.m. SGT, we're doing a webinar for NEO on whether this is the right time to invest in NASDAQ. And the third webinar is an M2W Tamil webinar on FOMO investing in small cap funds. If any of these topics interest you, register using the link in the description. Welcome to the April 2025 Fixed Income Outlook. This time we're going to talk about how to make your fixed income investments work in a falling interest rate environment. For everyone who's watching this video, you already know that the RBI cut rates in February this year, and there is talk of a rate cut happening either in April or in June. So let's look at how investors need to think about a falling interest rate environment, why the RBI is expected to cut rates further, and how to plan your investments in this new environment that we're dealing with. So if we look at our interest rate history, we would have noticed that the RBI actually maintained rates at 6.5% for almost 2 years. So our last rate hike was in February 2023, and our first rate cut after that was in February 2025. So for 2 years, we've been at this 6.5 level, and now we've moved down to 6.25%. So if we look at what has driven these rate cuts, I think one thing that is obvious is the liquidity in the system. So since last year was an election year, the government spending was quite constrained in the first half of the year. And then, of course, once your portfolio allocations happened, there started to be more spending, but we've also been on this consolidation path. So every year, the government has been spending less and less as a percentage of GDP. The second thing, of course, was we had tighter conditions, and now you're seeing monetary as well as fiscal policy push into easier conditions. But this has not fully translated into liquidity within the system. So you still have the RBI intervening with open market operations as well as your dollar rupee swaps, which have been happening through March. So when we look at system liquidity, this seems to be the priority in terms of why we're moving to a lower interest rate environment. The second thing that we can think of is how growth has changed. So the expectations last year was that India would continue to grow at 7.2%, but those expectations have actually been revised downwards, and you're seeing a slowdown in terms of growth. So while India has slowed down in terms of growth, we are still not a slow economy. We don't have to worry about things like a recession or a complete standstill when it comes to growth. We are doing quite well compared to other peers, whether you're looking at emerging markets or advanced economies. Now, the third factor driving lower interest rates is actually inflation. So if you've been paying attention to RBI commentary or even to your grocery bill, you would have noticed that you were paying a lot more for fruits and vegetables last year. So in the last 7 months, you've had an inflationary period, and the lowest reading in the last 7 months came out for February CPI at 3.61%. So the RBI's target for inflation has been around 4%, and with a tolerance for inflation to be at either 2% or 6% on the lower and the upper limits. So with the inflation reading coming in at 3.61, we've actually come below the 4% target in a long time, and this gives the RBI some space to cut interest rates without fueling inflation. However, when they think about inflation, there are other risks that they need to consider. One, of course, is the monsoon season. That's a big dictator of how inflation trends progress. The second thing that you could look at is geopolitics. And the third factor is tariffs. So tariffs have been making a lot of waves and headlines, and we will have more clarity in April as to how the US is going to respond to India's tariff equation. So that wraps up the RBI aspect of the outlook. If you want to stay tuned to what the RBI has to say in its April monetary policy, subscribe to our channel and you'll definitely know our analysis. Moving on to the next part, which is the investment outlook. So what are the risks that an investor should be looking at in this environment? When interest rates fall, bond prices actually move up. This is simply because An investor is always trying to maximize returns, and the current interest rate is an indicator of the borrowing cost for an investor. So when interest rate moves down, what tends to happen is older bonds tend to give higher returns because they make higher interest payments. So they are more in demand and the prices of those bonds move up. Whereas newer issues tend to move down because they're not able to compete with these old bonds which are giving higher yields. So this situation of prices adjusting essentially ensures that all investors tend to earn the same kind of return for the same level of risk that they assume with their investments. So this is a simple way of thinking about how you should look at your investments. So if you've already been an investor, it's very likely that a rate cut is a positive signal for you. If you're someone who is not really invested in fixed income until now, then you need to start thinking about how you want to plan your allocations. Because all of the factors considered, I think we can expect this rate cut cycle to be a little bit more shallow because India is not really a slow economy. We're keeping inflation not too far from our targeted range. At the same time, you have other positive drivers and efforts that are going into liquidity management. So keeping all of this in mind, maybe rate cuts are not going to be the only tool that the RBI uses. At the same time, transmission also matters. So when you're looking at making new investments, you need to be very careful about managing your duration risk. There is a tendency for investors to move into long duration assets when the rate cut cycle starts. But your entry level yield matters a lot, because if you enter a duration asset at the wrong yield, you could actually face losses when the cycle turns. And it's important for you to be aware of those risks before you make an investment decision. It's also very dependent on your investment horizon and whether you have the capacity to hold investments to maturity or not. The second thing that an investor needs to pay attention to is reinvestment risk. So if you're somebody who's invested in a fixed income product, you aren't going to be able to earn the same return, say 6 months or 1 year down the line. So whatever level you're able to reinvest at, it could be lower or higher than where we are today, depending on which way interest rates move. As we move into a lower interest rate cycle, you need to mentally prepare for lower returns from fixed income. Now, normally this is an area of concern for fixed income investors, but if you think about how inflation has played out and if you're expecting inflation to trend downwards, then you need to focus more on managing your reinvestment risk rather than looking for inflation adjusted returns in fixed income. Now, the third risk that might be on investors' minds is market volatility. So January, February and most of March have been very volatile months for equity investors, and there has been a shift in sentiment where investors have been seeking more liquidity and more stability from their portfolios. Fixed income could be the perfect asset class to give you those advantages. However, at the same time, there is a return differential that you might earn between these two asset classes depending on what your investment horizon is. If you're an investor who's seeking to be more confident with their decisions, then fixed income could help you tide through this volatile market phase. Whereas if you're a more long-term oriented investor and you want to make good returns and start sowing the seeds in this phase of the market cycle, then this is a good idea for you to have some assets in fixed income which you gradually move into the equity markets based on opportunities and valuations. So fixed income could still suit an aggressive investor, but its purpose might vary a little bit. This brings us to the last segment of the outlook, which is how should you actually be structuring your investments? If we think about what this phase has to offer to us, one thing is clear, which is that we need to be a lot more selective in our products. And our products need to be flexible. So if we have to start thinking about reinvestment risk, the product should be able to adapt to newer market conditions and have a more flexible mandate. Alternatively, if you have a clear investment horizon, you can lock into products with fixed returns for a fixed period of time. This might compromise some level of liquidity, but at the same time, it gives you a clear return over a fixed time period, which you may not get from other market-linked products. Last but not least, it goes without saying that when you're making fixed income decisions, always prioritize safety over returns, because there is a cap on how much you can earn from an asset class like fixed income, and it's never worth risking your capital when your returns are capped. So here's to safe investing. If you found anything in this outlook insightful, share it with a friend and stay tuned to hear our update on the RBI's monetary policy.